Wall Street was shaken this week as one of the world's most valuable tech companies triggered a wave of concern across the market. Investors closely watching the technology sector were caught off guard as a major earnings report, despite beating expectations, failed to calm growing fears about rising costs and slowing momentum in a critical business segment. Market sentiment turned sharply negative as traders focused less on headline profits and more on what lies ahead. While revenue growth remained strong on paper, concerns emerged around future performance, capital allocation, and whether current investments will generate the returns investors are expecting. The broader tech landscape showed mixed signals. Some companies impressed markets with strong advertising and business performance, helping their shares rise. Others, however, faced selling pressure as investors became increasingly selective about where they are willing to tolerate heavy spending. Behind the scenes, analysts pointed to a key issue: massive investment in artificial intelligence infrastructure. While AI is seen as a long-term growth engine, the short-term financial impact is weighing heavily on investor confidence. Rising capital expenditures and limited GPU availability are raising questions about efficiency and near-term profitability. Cloud growth, long considered one of the company's most reliable profit drivers, also showed signs of slowing. Even small decelerations in this area were enough to alarm Wall Street, as expectations for cloud expansion remain extremely high. Several analysts warned that unless cloud revenue growth reaccelerates, market sentiment could remain negative in the months ahead. Others went even further, suggesting that the surge in AI spending could be creating bubble-like conditions into the tech sector. There is also growing focus on how dependent future growth has become on strategic partnerships and next-generation AI platforms. Some experts believe that a large portion of future revenue now hinges on the success of AI-driven products, increasing both opportunity and risk. In the end, despite beating earnings expectations and reaching a record $50 billion in cloud revenue, Microsoft shares plunged nearly 12%, the company's worst single-day drop since 2020. Driven by slowing Azure growth and heavier than expected AI spending that rattled investor confidence.